Absolutely, 250,000, impressive on the headline number, a two-month high. But remember, this is coming after the lowest level that we've seen in more than a year in September payrolls. So when we average that out, we're talking about the trend pace still well below 200,000, at least over the past 8 weeks. Also, wage growth. Wage growth did push back higher. This is a welcome talking point for the administration, and certainly the Fed will look at this as further justification for a potential rate increase at the end of the year. But we've also seen these one-off data points before, pushing above 3% or near 3%, and then falling back down. When we look at historical cycles, wage growth has maintained a very positive trend well above 3%. Go back to the 90s, we're talking about the recovery with wages well above 4% on a sustained basis. So I'd really like to see wages maintain a prolonged positive trend as opposed to getting excited off of one data point here and there.
Right, but I mean, you got to start somewhere, and all the indicators, right, should be that this is
You do have to start somewhere, but it's 9 years into the recovery. This is a pretty late starting point.
But we only right now have this 3.7% unemployment rate, and I will say that I averaged the last 2 months, and it's 180. And even if it was 180 today, I would still have said that's a strong job market. Remember, the country is creating a workforce at 70,000 a month. So what does that mean? It means we're making jobs that are more than double the entrance to the workforce, which means we're soaking up slack. So let's move it over to that thing. How much tolerance is the Federal Reserve going to have here for the decline in slack in the job market the way it's going?
Well, think about the unemployment rate. It's been well below the lower bound of what the Fed designates as full employment since March of last year. So we've seen this type of very low levels in terms of unemployment, but it hasn't translated, hasn't positively correlated to significant and meaningful improvement in wages. So again, I don't know if we can necessarily say that this morning's report begets continued improvement in wages. And if we look at other inflationary metrics, when we look at third quarter GDP, what did the PCE deflator do? Fall down to 1.6%. Right. So I don't think there's a lot of inflation concern for the Fed. They're watching it, but the inflation dragon doesn't seem to be lurking around the corner such that the Fed needs to worry about accelerating the rate path for rate increases, not only at the end of the year,
Lindsey,
but into 2019.
Lindsey, what do you make of how the market is reacting to all this news about trade? Is that an overriding concern here, even more so than the Fed?
Well, I think it is a concern because right now when we look at the implementation of tariffs and the retaliatory tariff implementations that we've seen from Beijing, we're shaving off about 2 to 3 tenths from baseline GDP forecasts. But if we continue down this ugly pathway to an outright trade war, with the president potentially slapping on additional duties to the remaining balance of about $267 billion, well, if we also anticipate retaliatory action from China, we could start to talk about shaving off 6 tenths from baseline GDP.
Wow, that's a big number.
Now we're talking about some real figures here, which could potentially then force, coupled with additional rate increases from the Fed, force the economy into recession sooner than later. So now we start to talk about the R word rapidly emerging as we look out to 2020.